So the Federal Reserve Bank doesn't actually print the money. The Treasury does that, and that's usually when they've been given the blessing by Congress to print more and put it out there. When they print money, they generally are creating a debt vehicle on one side. It's going to be Treasury bills, Treasury bonds, Treasury notes, and then they issue those out. So these can be pieces of debt that are anywhere from a couple of months out to as long as 30 years or longer. And so at the auction, it's going to come out at par. It's going to come out at $1,000 per bond. You're going to see a variation, from let's say the previous day or pre-auction on what the interest rate is that it pays. So if there is more demand, you're going to probably see a slightly lower rate on the coupon that bond pays. If there's less demand to buy those bonds at issue, you'll probably see the coupon rate or the interest rate that bond pays go up a little bit until it goes up high enough until enough demand comes in to fulfill the order. Like with anything, if there's more demand for the amount of bonds being issued, so let's say they're coming out with a $10 billion offering, floating 10 billion more in bonds, and there was demand for 20 billion in bonds. Likelihood is if that demand is met, you're going to have to actually raise the price of those bonds. And thus, that would drive down the interest rate that those bonds would pay, because bonds have a unique characteristic that the higher the price goes, the lower the yield is for the investor. Anyone that's owned bonds over the last decade, you've seen the price of your bonds move quite a bit because rates went down so much and then now back up. And the typical bond that's been out there for the last 5 years or more is likely to be trading at a slight discount to what it was originally issued at if it was issued sometime when rates were still down about 1 or 2%. Bonds that were issued above the current market rate of say 5 or 6% are probably trading at a premium to what they were originally issued at from a price perspective.